Hello and welcome to another episode of the R&D podcast, where Danny and I are going to catch you up on the goings-on inside of Dallas real estate, mortgage, and generally the state of the industry too, because, mortgage and real estate, that's a nationwide topic. And yes, of course, inside of each individual market, you'll get different trends and things that happen that change the game a little bit, but they're addendums to the bigger picture, right?
Exactly. Yeah, absolutely, man. And it's always constantly changing. So glad to update you here again and get ready for what's coming next, hopefully, and give you a little insight of what's currently happening in the market.
Absolutely. And it's almost spooky season. We're nearing the end of October. Last time we chatted was a little earlier in the month. Danny, how's the month been for you? How you doing?
Yeah, well, I don't want to keep it too spooky, but I know there is lingering fear out there with what's happening in the market. We'll get more into detail about it, but things are still great. I think there's light within the tunnel if you kind of know what to look for. So a couple of tips we can give later on as well, but there is this kind of feeling that we can't do anything right now. But if you kind of get with your realtor, I think there's some couple creative ways that we can make a deal happen if you are looking to buy or, get into the market.
Absolutely. Look, I'll say this. I've said it on nearly every episode that we've recorded on, but I really do believe it, that in the world of real estate and mortgage, it is always, so I don't want to say it's always a good time to buy. It's more that I don't think times are better in one spot than they are in others, because there's always give and take. Right now, rates, in case you don't know, I won't hide the ball, they're as high as they've been since the 1990s. Yeah. You'll have plenty of people, you show this podcast to your parents, they'll tell you, oh, well, in the 1980s, rates were 13%. Everybody wants to talk about 17% rates in the 80s, right, back when a $400,000 house today cost $80,000. Yeah. And I would pay that price too.
Right. And I've also, on that topic real quick, I've also heard that when you actually do the numbers on, what people were earning back then, mm-hmm, what the house was worth and what the interest rate was in that time, when you do it side-by-side comparison, they're actually still better off back in the day, because there's more power back then to afford everything at that time. And right now, our income, our interest rate, and our price point of the house isn't matching up on a one-to-one with what it used to be back then.
And that's exactly what I wanted to get at. Like, people saying that it's scary out there, they're right. The main thing you get now that you won't get when things are better is the flexibility of being one of the only buyers in the market. You are a fish hunting in a pond without any other predators, basically. Like, that can be an advantage too. You've scored some sweet deals in and around this time for clients because we had leverage that you simply won't get in, say, maybe a year and a half's time or something like that. Absolutely. Because then, when rates do fall, it will be more affordable. You will just have to make your deal sweeter than 25 other home buyers that all liked that house. And that's a life that people were living, 3 years ago? Yeah. 2 years ago now? Yeah. The pandemic wasn't that long ago.
It's really crazy how fast things go. But yeah, it's just like that. Things have shifted over. So how can we be smart today? And how can we make those moves to allow us to get in the game now before things get crazy? And then, there's multiple ways of doing it.
And there's so many different topics to discuss there, because I know you have on your note sheet a bunch of different things you want to walk through. But let's use a great example. So right now, for those who don't know, house purchases, home or mortgage applications, and refinance applications are as low as, based on index tracking that I've looked up, since back to the 1990s, the 1980s. They are really low velocity, 45% lower than they were in pre-pandemic levels, which is a massive fractional hit. Yeah. And it makes a ton of sense too. After all, people had an opportunity to buy, and anybody that could buy has bought over the last 2.5 years. So now everybody is buying and holding that real estate. Can you assume their loans? I hear that topic a lot. Absolutely you can. It's just a little more complicated than, and now I got their loan, because those people bought a house. I'm going to use some easy numbers. Sure. They bought a house for $300,000 in 2020, and now that house is worth $410,000. So how do you cover the gap? There's different ways you can go about that, right? Because you do have to get the extra money to meet the sales price. But that said, that can be a nice tip and trick if you qualify for the buyer's FHA or VA loan, and you do have to meet the initial or like the original qualifications. If it's a VA loan and I didn't serve, I can't qualify for that VA loan.
Right.
If it's an FHA loan, that's great, but you need to meet those FHA qualifications, of which can vary from buyer to buyer.
Yeah.
But the point is that there are really neat ways that you can leverage the state of the market right now. I really do believe that for first-time home buyers, it's absolutely worth thinking about, because it is much easier right now to get a good price on Dallas real estate than I think it will be in a year and a half's time. And me personally, Danny, from my own real estate buying experience, I thought it was so much nicer that we were the only buyer really bidding for the property that we ended up winning, because that process of losing houses, we lost like 3 or 4, can be really damaging.
Yeah.
That can beat you up when you keep losing properties.
Yeah.
And when this thing turns into a feeding frenzy, a lot of people are going to lose a lot.
Sure. And you can even focus on the whole picture instead of just the price point, right? When you buy a house and you buy it later, you may see that price increase, right? And along with that price increase, think about the taxes. That's another aspect that I don't think a lot of people are even thinking about. I buy a house now, it's at a current value, right? Let's say $300,000. I wait a year from now, gosh, if it goes to 400, unfortunately, right? You're going to have that on the record, unless you go off market or something, right? And it's going to be 400,000 versus 300, and those taxes will change. You're not only losing out on that difference of price that went up, but you're losing out more on paying more taxes a year.
So in case it helps, the good news is that the state of Texas has actually separated the appraisers done by tax assessors and the appraisers done by real estate. I don't know what you'd call them, I guess. Just I call them appraisers,
Sure.
right?
Yeah.
But the appraisers that are involved in a real estate transaction. This doesn't always work, and I get that it sounds like cognitive dissonance, but I have seen a tax assessor that has so for the house that I bought it for $412, and then the tax assessor came in and labeled it $450, which we had to protest using our existing appraisal to be like, no, it was $412.
Yeah, exactly.
And they ended up taking that because honestly, the state will kind of roll over if you challenge them.
Sure.
But it's more to say, Danny, that the fact that you changed its value, like through selling it at a new rate, a lot of times that won't prompt the taxes to change. The taxes have been changing, but I've seen a lot of mortgage servicers that won't update your escrow payments, and that's on them, if that makes sense.
No, sure. I mean,
but it can all end up feeling the same.
Yeah. I guess the whole point is that when you really wait long enough, it starts adding up. Absolutely. In the smaller increments, right? I know it may not be a huge difference, but think about everything lined up and you add it up. It's going to be more than what you think.
And recent legal changes to home insurance have made it to where home insurance prices have gone up almost 60%.
Yeah, I don't even want to talk about my car insurance right now. It's been a mess. Some people even uninsured in California because they won't insure that area anymore due to risk. Yeah. So, yeah.
Like you're saying, it's an expensive time. It's an expensive time.
Yeah.
And the best news I have for any home buyer, potential home buyer, somebody who wants to own a home eventually, the best news I have for you is that it is free to get your situation looked at by somebody like me, to start talking to somebody like Danny. If we build a plan that we're going to execute on in 2.5 years, when that promotion comes, when this person moves from this state to that state, whatever your life situation is, you can plan ahead, and a mortgage person can be right there to tell you, these are the rules of the game. This is the salary we need to get you the house type you want, and this is the area that you want to live in. Well, we're probably going to be looking at a price of blank. Yeah. You get it. Sure. We get it.
No, yeah. I think, Robert, I really do think, some people are saying, people are trying to get you to buy at any point. It really is. Think about this. Like you said, mortgage rate and new mortgage originations are down. Okay. Affordability, I know it's getting a little out of hand, but that's everywhere, right? What we can't control is out there, but what you can control is controlling the things that are right in front of you and saying, hey, look, I can get in the market when things are not as competitive. You can choose to do that. Even though the market's not in your favor, you can still choose to make a decision that's favorable for you then, even though the variables are not, at your,
Absolutely.
So you're saying all these things that are pretty crazy, but when I think about it, we didn't even talk about this. Investors are even backing off.
Right.
There's very, very low investor activity. What does that mean for the buyer? A better probably opportunity because you're not competing with that cash offer.
It's just less people in the market, which I think is really positive to anybody who's willing to brave it. And I mean, this sounds, so what I'm about to explain, I'll go top to middle. We won't go all the way to the bottom. But while I sound like a mortgage salesman, anybody who's seen The Big Short, you have seen how much of the private equity, it's not private equity, but like how much of the financial sales, stocks and bonds market is pinned up by mortgage-backed securities. Like mortgage-backed securities are market movers and they are major drivers within the investing world. They make a lot of people a lot of money.
Yeah.
Because of that, man, do people love writing new loans. People will do anything to write a new loan. The bank makes money when we write a new loan. The loan originator makes money when you write a new loan. The title company, the servicer, the everybody. It's why the refinance exists. Like the entire purpose of the refinance is pay back that original loan with a brand new loan so that we can write a new loan.
Keeps the train going, essentially, right?
If you think about it, people would have hated this. Are you kidding me? You're stealing 20 years of interest because you're paying off this 30-year loan 10 years in with a refinance. But they don't argue it because everybody wins with the refinance, you included. Yeah. So today's rates, you probably heard about them. They can be as low as 8%, which is not low. And they can be as high, depending on your credit, as like 8.675. That's conventional. FHA can get a little different. It depends buyer to buyer. But the point is, when rates go down, you get to lower your rate. Yeah. It sounds fake. I wouldn't believe you, Danny. Yeah. I'd be like, this can't be real. This is like one of those can't miss investments. You know what I'm saying?
Absolutely.
But you can buy a house now. This sounds, again, I would barely believe you, but it's real. Like you can buy a house today at $400,000. You can pay more mortgage than you want to. I'm sure that's the case. And then if and when rates fall, say to 4.5%, you will lower your 8% rate down to 4.5%, and it will stay there until it lowers enough. Say another pandemic happens, God forbid. Yeah. But we get down to 2.7%. Now you lower your rate again with a second refinance to 2.7%, and there's not really a downside. Like at least from what I've seen, refinancing, you get some closing costs, but you roll them into the loan, and so you end up basically paying off the extra expenses with savings. Yeah. So you net savings in that case. Yeah. Why am I talking about this? Because when rates go down and buyer activity improves, what happens, Danny?
When rates go down,
rates go down.
The demand is just going to skyrocket.
And what does demand do to prices? It raises
goes
them.
Up, yeah.
And so if you bought a $400,000 house at an 8% rate, you could end up 2 years later with a house that's worth, what do you think, 15? 18% more?
Probably.
Like in a hot market?
I mean, I think it's going to get there eventually. It's just a matter of time. And right now we're coasting, but
That's a person's salary, Danny. Yeah. Like 18% of $400,000 would be like what? About $78,000, give or take. Right. And it's not money in your pocket, but it's equity in your house. That should you get an opportunity or need at any point to pull it out, a home equity loan, blah, 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 a bunch of other stuff. Right. But it's more to say, Danny, that I see real opportunity for somebody who wants a house, has a stable job, or honestly just makes decent income that you think you could afford a house, you might be able to. And hey, maybe you're looking at a lower price point, right? But you could get a house before the feeding frenzy starts because it's going to come eventually.
Yeah. And there's plenty of ways we were saying about saving, refining. There's plenty of ways to circumvent that at the beginning. And if you don't mind, maybe we could just talk a little bit about it. I know it's been in everyone's radar as far as when you are buying with some of my clients, we kind of present it in a way where, hey, we could potentially make this work with the seller. What's hot right now, you may have heard it. It's a 3-2-1 buy down. And Robert will go into a little more detail, but I'm just going to briefly touch up on what it maybe takes to even get someone to accept that.
Right.
So you can kind of explain how it works. But essentially for me as a realtor is I can go ahead and negotiate an upfront discount for you at the closing table, but it takes a good, I guess, explanation to someone who's selling a house to understand the concept, but also agree to something like this. Because at the end of the day, you want a win-win situation. You're going to want the seller to get what they want, and you want the buyer to get a little help out of it. So what we'll do typically is you go up to the seller and you're going to want to say, hey, look, I can offer you something that's really fair to you, even maybe exactly what you want. But in order to do this, if possible, let's go ahead and circulate some of those closing costs. And I know in previous episode, we've talked about credits and that can help you with fixing up the house. But why instead of, if the home is okay and you can budget for that later, why don't you circumvent that instead of doing a fixer-up project, put that money into the rate. And we'll actually help you bring that rate down at the beginning. As the loan ages, things will shift, but at the very beginning, it'll be 3 points maybe lower. So it could be less than a 7.5. We could possibly even see a 4 in a 7% market. So you could save right away. The seller normally will go ahead and give you that credit, and at the closing table, that'll go straight to your rate. And if you want to just kind of briefly explain how you could structure that and how it changes over time, the rate,
yes,
so people can understand like how that works really.
So basically what you're looking at with a 3-2-1 buy down or a 2-1 buy down, anything where you hear a set of numbers that sound like they're counting down, like this is a temporary buy down. You may have heard of discount points, a standard permanent buy down. That's expenses at your closing cost to drop your rate from 7.5 to 7.25. And then it's a 7.25% fixed 30-year loan over time. This is a temporary buy down. 3-2-1 means your first year's mortgage is 3% lower than it should be. Your second year is 2% lower than it should be. And your third year, you guessed it, is 1% lower than your mortgage, again, should be. What does this mean for me as your mortgage person? You still have to qualify at that higher rate. So if you're buying a house, you have to theoretically be able to afford an 8% interest rate.
Doesn't mean you're going to pay it at the end, but you still have to start with that qualification.
We hope, right? But then you're going to basically take a chunk of change from the seller in seller concessions and subsidize your mortgage rate. How does it go down 3%? Because you've already set aside whatever money it would take to spend that, like the difference in money that you would spend over a year's mortgage, and you've put it into a separate escrow account that your mortgage servicer on your behalf is adding to that bill. Now, it's funny, Danny, because theoretically, any temporary buy down is something that a buyer could actually do manually themselves. Let's say you got a buyer $12,000 in closing cost remissions when they had $12,000 to spend in closing costs. If the buyer took that exact same amount of money, moved it into a checking account themselves, said we would have spent this, but now we're going to use it to run our own mortgage subsidy, you can achieve the same effect in a lot of different ways. But it can be awfully nice to have a mortgage servicer handle it for you so that your bill, when you actually get charged, feels nice and low.
It's a great way to think about it. It's like a little separate savings account that will always be there as a backup, because that way you're less enticed to like use it on something else if you're going to self-manage it. But correct me if I'm wrong, but if I'm not mistaken, not only does that manage your buy down, but it's an escrow that will also help you refi.
So
that's when we get to the point of like, well, it's a 3-2-1, right? 3 years or something like that. You think within those 3 years, maybe rates will change. And at that point, you can renegotiate with your lender on what you can do next.
The person this is for the person who can qualify for that higher rate, but doesn't want to pay what the mortgage cost associated with that higher rate is. So a temporary buy down will make the payment much more affordable. And the best news, like you're talking about, so 3-2-1 buy down. You've set aside, let's say $20,000, right? Well, I want that $20,000. Don't you, Danny? If that was you, I mean, if I don't want to refinance and cost myself that money. The good news is you won't. Let's say you refi 6 months into the loan. That would be best case scenario. Or maybe you refi 18 months into the loan. You haven't spent, in that case, it's not about half in real world math. It would be a little bit, it'd be about a third. You haven't spent about a third of that money. That money, whatever's left, gets applied directly to the principal balance of your loan when you go to refi. So you keep the cash that you got from the seller and then apply it to that refinance. Now, like you talk about, Danny, the caveat here is that you got to get that money somewhere. So the seller has to agree to give you, especially in the case of a 3-2-1, sometimes as much as $20,000 to $25,000 in seller remissions. Would you like to talk through the common way that we do that? Sure. Because we came up with this together.
Right. Yeah, absolutely. So, and you're saying remissions is in like the
remissions, concessions, it's all the same word.
Yeah, okay. Just for clarification,
No, I get you.
Yeah, so I mean, there's a lot of different ways to rephrase it, but essentially you're selling the idea that seller is getting exactly what they want and the buyer will need a little help with whatever it takes to bring up the house to speed or something. Maybe you need to fix something, right? Essentially a credit to help you do what you have to do to your house to, take care of a couple of things.
Totally.
You could keep the price point where things are at and then go ahead and use that money and, buy down your rate. And that way the seller doesn't budge and they're kind of like, okay, yeah, that's fine with me. Sometimes you say, hey, I want a discount on the price point, and that won't really help much, right? Like we need that credit up front. We don't want to take the price down because then the seller's going to say, wait a minute, my point is you might as well get the credit instead of lowering the price point of the house. Seller gets the same amount of money, but you get that credit back and helps you on the interest rate side.
But how have you gotten that credit?
Oh, okay. So you want...
I'm saying brass tacks. Like, okay, so somebody says, I want a 2-1 buy down, right? They come through, they say, let's get this house, let's get a 2-1 buy down. Danny, how are you going to get me this credit?
Sure.
You and I, we've talked about how to do this. We've even won one at some point.
That's true. Well, so listen, I don't mean to go into a house and like pick out everything that's wrong with it.
No.
But the idea here is that you want to go in there and really think about like, sell to the seller the idea of like, hey, put yourself in the buyer's shoes. And if you want a great functioning home and you're paying so much money for it, right? At least give me a home that everything works or something like that, right? Maybe there's just stains all over the carpet and you're like, look, man, I appreciate this house and it's beautiful, but like these carpets really need to go, right? So ideas like that, maybe in the future, you're going to have to make these repairs because they're not looking so good now, even though they're working. But the seller will somewhat understand like, hey, look, they are coming up with a lot of money here. And I am getting what I asked for as a sales price. The least I could do is, we'll keep the price point as is, but the seller eventually gave us a credit to help us fix for certain things. You may not use all that money to fix those things.
No.
And instead of, fixing those things right away, which you could always plan out later, you use that money immediately, like you said, on that balance and put it down on escrow to help you buy that rate down.
And another thing that I've seen really, really help is in plenty of situations, so you're haggling with the seller. If you ask up front for seller's concessions, I've seen that be a real big red flag to a lot of sellers. Sellers hear you asking for concessions up front and they go, what, do you not have the money to buy the house?
That's a good point.
And they get kind of fritzy. So what I have seen, Danny, is that so let's say you're the seller's realtor and I'm the buyer's realtor. And we're going back and forth on a house. Let's say the actual value of the house is $400,000, but you priced it at $410,000. So I bring you down to $3,900 or $390,000. And what I can do to get a $10,000 concession then is to offer you, once we agree on a $390,000 take home, because that's what it is for the seller, right?
What are they gonna?
That we can bump it to $400,000 and with a $10,000 seller credit. And then boom, I, the mortgage lender, have the money that I need to submit this as a seller paid buy down, because that's the thing. the buyer can't buy their own 2-1 buy down.
Correct.
It's a legal problem.
Right.
I'm sure it has something to do with anything from fraud to a lot of these things in mortgage ultimately bubble back to fraud.
I was thinking about that. I just wanted to be also very careful when you do say those kinds of things, like you run into appraisal issues. So
you can't.
So that's why I wanted to stay away from that risk. But in general, Robert is right. That is another way of really, and you're right. There has been that situation where we got one of a client to be able to win that way. But just be careful that some markets may not be, especially hyper local, that neighborhood, right, may not be as reactive to that sort of price increase. So you increase it and you run into issues as like, oh my gosh, the house isn't appraising. So
that's where, like you're talking about, Danny, number one, the buyer needs to know what you're getting into when you go there. Right. But also, Danny, you did a great job on the deal that we specifically did this on, because before we ultimately picked out the housing price, we always knew we were going to try this, and you'd done the homework to realize that it should appraise at the value that we had in mind. Yeah. You can't do this loosey-goosey. Yeah. And the good news is that a mortgage lender that will suggest this, I am talking about myself, but a lot of mortgage lenders have probably had this idea. Most that do will make sure the realtor is on the same page with them of, we are going to appraise at $400K. Yeah. Right?
Yeah, definitely. Doing the homework was something that has to happen. So couldn't agree more. And I'm glad you brought that up. It's an example that is warranted. Yeah, I agree. You could do it that way. You just have to be very careful and just make sure that it is the right deal and everything's lined up.
And then if it underappraises, I mean, there's an amazing amount of things. Look, I'm a mortgage lender. Yeah. I'm very buyer side. Yeah. But within that, like, let's say that it doesn't appraise. So it's $5K short of what we needed. Well, the buy down needs, first of all, the buy down can be adjusted. It doesn't have to be a 3-2-1. Yeah. It can be a 1-1. Exactly. It can be a 1-0. Yeah. It can be a 2-1. It can be functionally whatever we can afford.
It's flexible.
Yeah. But we can also go back to the seller and say, hey, so the only way that we're going to be able to buy the house is if we get this if we got this 2-1 buy down and the house didn't appraise the way that we wanted it to. Right. What can we do to get a $5,000 seller credit? Yeah. And you'd be amazed at how flexible some sellers are.
At the end of the day, too, they don't understand that until they get to that point, because then there's a report and there's like, hey, like, this is the situation we're in. Some sellers may just not know that they overpriced and they're thinking, hey, like, I can sell it for anything in the world out there. Well, there's a limit, right? Right. And they're now realizing this when you're in that situation. So that's when you can have a conversation and get to the table and really talk it out with them and say, hey, look, what can we do to move this deal forward? Because we're so close, but we're, just short a little bit. Right. And there's adjustments you can make on either end. So on the buy down end or even the price, but whatever we have to do, that's a conversation we can have when we reach that point, essentially. Right. But yeah, I think that really essentially in a nutshell wraps it up for what you can do in that sense. But it's just been popular this whole year, right? And hopefully it will still work as long as the rates stay this way, because it's the best thing I think you can do to get a jump start on saving money right away. Oh, yeah. Obviously, you can get creative in different ways, but that's one of the easiest ways. I think you can just right off the bat, as soon as you write the contract, you have it there on paper, and you know what you're going to get when you do the numbers. So to that end, I mean, is there any other kind of stories what you've run into? I mean, we've been coasting, y'all. I mean, we have seen no inventory, some cash buyers out there, right? I think that's what's really somewhat winning it, is like, there's so many cash buyers out there still kind of going after some, because they just don't want to spend the money on.
And that's the thing, right? Like okay, so we could talk about like cash programs, because there are plenty of mortgage people that can do, like, you can basically spoof a cash offer in many cases, but that's very, very case by case and ultimately depends on what you need, why you need it, et cetera, et cetera. But the big thing that I've seen with 2-1 buy downs that is really popular and common and good is that it is a hedge against high rates, but it is also a hedge against rates going higher. Yeah. I wrote a bunch of 2-1 buy downs last October, right? And when we were writing them, it was under the guise that we hoped rates would go down, and then they did a little. They went down from 7.5, or they were at 7.25 at the time, and they fell to about 5.75.
Yeah, I remember.
And then they spiked back up. But we talked at the time about how, and also if rates go higher than 7.25, nobody wants to think about that. Nobody's going to project it. People aren't even going to write that that's coming because that's a future nobody wants to live. But it's possible.
Yeah.
And if that happens, you're holding on to a 7.25% conventional 30-year fixed.
Right.
Because these 2-1 buy downs, they are a gimmick front to one of the more stable loans in existence. That 30-year fixed is rock solid. And so in a case, Danny, again, nobody wants to believe it right now.
Right.
No, nobody does.
Yeah.
But if you get a 3-2-1 buy down right now, and then 3 years later, rates are at 10%, and the American economy is really struggling, you're sitting on an 8% loan, not thinking you've got this amazing deal, but it's a better deal than the rest of the market has.
No, absolutely. And it's available pretty much in a lot of different ways. I mean, you can get what we're talking about in a conventional FHA. I mean, lending is so flexible. It's unbelievable. It's almost like you have endless options. It's a little overwhelming, and that's why we have people like you to help understand it better. But yeah, I mean, we could even get into like the investment side of things. Like, what do you think? Like, is there still room as an investor? I mean, I know we mainly talk about residential home buying as primary residences, but is there room, you think, like as an investor to still buy? I mean,
there's always room to look.
Yeah.
That's for sure. Right now, it seems like, I mean, you've dealt with this.
Everyone's backing off, you know.
Everybody's backing off, and I mean, it doesn't help anything that with recent changes to stuff like Airbnb and Vrbo,
That's true.
you're seeing the investments. I mean, say what you will, like a lot of investments are driven by good, really well-researched information. And Danny, you know the flip side of that. A lot of investments are driven by knee-jerk, impulsive. I watched a TikTok and they said that I could make $12,000 a month, so I got to do it.
Yeah.
And they just jump in. Not every investment's going to make you money. Yeah. Not every investment's going to lose you money. And I can't help but think that the Airbnb, like I'm going to own an Airbnb and I'm going to rent it out, and I'm going to ask the people that come to my Airbnb to do a million chores to keep it clean for my next buyer.
Yeah.
All the stuff with that, right?
It's a nightmare sometimes even buying an Airbnb property because of the condition it is. Right?
Exactly. And I mean, there's a lot of people that made a lot of money.
Yeah.
So much money that it created so many problems that Airbnb is getting run out of certain cities across the United States.
Right.
So it feels like, I mean, I'm not saying Airbnb is the reason that investment slowed down. Rates haven't helped anything.
Yeah.
But especially once you get back into the more standard tenant cycle, high rates just mean that it's a lot harder to instantly make money.
Yeah.
Because just because you paid 8% for your mortgage doesn't mean that you can charge above market rate and expect somebody to agree to that tenancy within a rental contract.
Right.
So right now, if you've got some cash and you're willing to float at a loss for a little while, you may make the same amount of money that anybody who buys a house would make when the market heats back up again. Yeah. It's just a matter of how long you're willing to float that. Yeah. Because again, let's use some made up numbers. Let's say that you get a mortgage, an investment mortgage, 20% down, and you're paying about $3,500 a month for a 4-bedroom, 2-bathroom house. And then somebody comes in and they're going to rent it for $2,600, right? Which hopefully you get that rent. Right. Maybe you wouldn't. You obviously have to ultimately pay the $900.
Paying for someone to live there.
You're paying for somebody else to live there so that you can hopefully grow this asset in the future. It's a much longer term play and could end up pretty expensive. Could have some major benefit, but people like less risk.
I mean, and for me, I like to at least break even as like worst case scenario, right? So, but yeah, I mean, just thinking about the logic of renting versus buying too, right? Since rates are high and rents are going to be more popular because people are going to go back to renting, wouldn't you think maybe that rents might go up given a couple of variables, right? To people are going to rent more now because they're not looking to buy, so they're going to keep renting. And I don't think the inventories really are caught up yet, right? So you add all that up, and I think rates for rental rates are going to possibly keep growing a little bit. I've personally seen it in my investment property where, I mean, yeah, there was a stability phase and there was one dip, and that's all depend. It could be seasonal too, right? depending on if you have a tenant in there 12 months versus a short-term renter who's in there 3 months out of the year. And so you keep getting new tenants. Maybe you got the lower rate because you happen to get somebody in where there's not that much activity, or, maybe a rough time out of the year. Who knows? But the point is that rates have kind of stayed steady and also climbed up a little bit, even after everything stabilized. So I don't know. I mean, you could still be okay. I mean, you still could potentially get an investment property in today's world. I mean, I do work with people who are still looking, and will probably still keep looking in the future, because there's always going to be opportunities out there. And again, we've talked about demand going down. Why not get in when people are backing off? I mean, it's like Warren Buffett, right?
Exactly.
You just buy when everyone is doing the opposite thing, right? So you don't want to follow the trend, and that's why don't we put that logic in real estate where you buy when other people aren't buying, right?
That's how I feel. Yeah. That's how I've felt for coming up on 2 years at this point, when I really started to pay attention. Right. I mean, you're talking to the wrong guy about rent, because I think renting, look, obviously this is the most mortgage salesman thing that I could possibly say, but I feel like rent ultimately is a slow way to bleed yourself out, right? Yeah. Like, not having ownership in something simply puts you at the mercy of the landlord and the market. And if Dallas goes super city, which you start to feel like it's going that way, then rent in areas close to where people work is only going to go up. Yeah. And as silly as it is, because like you talked about taxes, if your taxes went up 20% in a year, you would ultimately pay about $200 more. Yeah. And that's in some really expensive areas in Dallas that are charging you a lot in property taxes. Most areas in, say, Richardson, McKinney, et cetera, even a 20% rise in property taxes, which isn't going to happen, because with your homestead exemption, you have a legal protection that caps your total tax rise at 10% year over year, which is yet another benefit of owning over a long period of time. I'm getting away from the point. The point is, your landlord comes in, Danny, and they say, hey, good news, we're only raising rent 25%. Yeah. Like, there's no argument. Yeah. Like, it's either take the deal or find a new place to live. Right. And I think the stability that buying offers, whether you're buying an investment property to get into that game, or whether you're just buying a place to live, getting away from the rent cycle, I think is a real positive. The cycle of movers, the cycle of parking garages, I don't know.
I'm seeing it with clients too. Like, these are real examples where I won't get too much detail, but basically we've been looking to rent, and all of a sudden, hey, you know what? We're going to buy. It just made more sense. I mean, you're looking at these rates, and I mean, gosh, like, they literally walked in there and said, wait a minute, how much is this again? And then they asked me to pull up all the data for a home for sale next door. It was just, a townhouse, so you could find easy comparables. It was a no-brainer for them. We did the math. Look, good thing for them, they were able to bring some cash to the table, which helped a lot. It's always situational, right? But in your situation, it could also work, depending on the payment, right? Once they talk to you, that's when you kind of make a decision. But these people were able to look at the numbers and say, wait, like, the taxes are only, almost $1,000 less a month if we go ahead and just buy this thing. And you know that you can get a little bit of equity buildup if the market goes the right way.
Exactly.
So, gosh, and that was so unexpected. I was just thinking of renting, and all of a sudden it just makes more sense when you start to realize like what is happening on both sides. And things are going to be different everywhere you go. That happened to be a very particular market where we got a little luck sprinkled in there. But you really have to face everything that's in front of you and make that good decision. What's going to be best for you? There's so many variables out there, so many things you can do with your investment, let's call it, right? Even though a house can have liabilities along the way, it's still somewhat of an investment, right?
And beyond that, I can't help but feel like people have the tone of renting and buying swapped, where a lot of people see renting as stability, right? They see it as low risk. They see it as all these different things.
I don't have to worry about anything breaking. It's steady rent. Well, for a little bit.
In a long-term vision, if you are ever considering buying, waiting to buy, always risks what the price is going to be when the time is eventually, I mean, honestly, your time to buy is rarely going to match up with the ideal time to buy in the market, because nobody can really pin down what ideal time to buy in the market thinks that means. Barbara Corcoran, realtor goddess from Shark Tank, thinks that now is the best time to buy in the market. But then Joe down the street would make fun of you for looking for a house in this market because he thinks it's the worst time like to buy in the last 10 years. People all disagree on this kind of stuff. But to me, Danny, renting is convenience. It's not safety. It's convenient.
That's a great way to put it.
It's comfortable.
Yeah. Especially if you're looking to move or something out of state soon. So there's so many reasons why. Like I understand why you say convenience.
Buying is vulnerable. Buying involves, it's not that it involves risk. It's that it risks you having to do something. Like, I mean, you gotta mow your lawn. If you have a lawn, like you have to, like you spill some water and there's a problem, you don't call a maintenance man. You gotta figure it out. You have a washer and dryer, you got to figure out how to get them installed. Like all the little things that come with owning a house, they can ask a lot of you, absolutely. But I think it can create a lot of stability in the way somebody lives, that at the end of the day, Danny, I'm not worried about where I'm going to be in 3 years. And if things come up, then I can sell this thing that is an asset the moment you decide to sell it, and use the money that I clear from having owned the house for X amount of time to fund whatever I'm doing next.
Yeah, absolutely. And there's just so many ways. Again, I keep saying it, but there is so many ways of traveling down this path. You could keep the house, you can sell the house, but how you get money out of something sometimes, plays with how much equity there is in the house and what market you're in, which, by the way, I'm going to, leave it like that. But a note about what we're saying is, in regards to this particular market, our listeners are probably in DFW, I'm guessing, obviously. So for most of us saying all these things, Dallas is very different from the whole nation, I think, in comparison. So do keep in mind that when we talk about all these things, specifically, they're going to mainly apply to Dallas. When we do say, like, the example of, hey, like right now rents are crazy and things like that. I mean, there could be other places out there. The renting makes more sense. And I totally get it for some viewers out there that know that you can go to, let's say, Arizona or something, New Mexico, and get a cheaper rent. Sure, that's true. But I'd like to say, seasoned vets now, like working in this market for several years. And we've ridden so many waves now that we truly understand the hyper-local market within our neighborhoods, within the Metroplex, right? We're seeing like a lot of crazy ways that rent could not be as good of a choice, even though some other places might be okay to rent.
Totally. And I mean, suburbs of Houston, rent may make a lot of sense. But in a lot of the areas of central and greater Austin, in central and greater Dallas, rents are just exploding all over the place. Like, there's no one best place to be in Dallas. I live in Richardson. Tons of people live in Farmers Branch. Tons of people live in Plano, Frisco, McKinney. Those are some of the North Dallas hotspots, and that's before you get to like the oh my gosh, I can't believe I'm forgetting. Well, yeah, there's north of that.
And Pilot Point.
But I was going to try to talk about some of the cool places in like Dallas. Like you get to the M streets. You get to like East Dallas.
Historic neighborhoods.
Right near Lockwood, Lakewood. Like you get to Park Cities, Preston Hollow. Like those are their whole separate markets. And people rent there too, but the rent's kind of nasty.
Yep. I know very well, actually. Yeah, no, it's interesting, right? I mean, you would never believe that, 20 years ago, and saying, oh my gosh, Frisco, for example, is going to be the average price point is now, I think it's 700,000 as an entry price point, not average. I'm sorry, an entry price point.
Hell's insane.
So you look at the map and how it's sprawling and growing, like it's just. Dallas is it's quite fruitful. So knowing how to take advantage of it and actually making that step to move forward into taking the leap and investing or owning something here, I think it's a great idea to consider at any point. Some people would never imagine they'd be buying right now, but now they are. So they've looked at all the facts and all the numbers, and it now makes sense to them. So Robert, I love what we talked about. I think I think that really wraps up most of what's going on. I mean, you're going to hear it over and over. We're not going away anytime soon. But if you have anything else to kind of add in there, I think we've given the viewers a lot of of what we've seen over and over, but just trying to help you guys along the way to navigate and potentially win the best deal at the current time.
And that's all anybody wants. If you've got any questions about anything, please reach out to either Danny at The Veggie Realtor. Is that the handle?
Yeah, The Veggie Realtor.
Mm-hmm. Yeah. You can find me at Schmitz Mortgage Texas, and we would love to talk to you because we ultimately want you to be able to win and get what you want, right? Like, yes, we want you to have the best deal possible, but there's a deal out there for you if you're interested in buying that's going to fit your situation better, whatever's going on in your life. And it's free to talk to us, and we're happy to do it. So I'm not going to say, what are you waiting for? Because it's way too hokey. But when you're ready, you just let us know.